Tell us how Janet Yellen's dovish comments yesterday are rocking your world.
Well, they're actually really well received because it's positive for fixed income, and it means that the policy error that the Fed looked like they were going to be making when we were assessing their policy path late last year, they're now backing away from that. And so this is good because it means that we can stabilise a bit, but ultimately that rise in US rates that many feared was going to happen probably now not going to materialise.
When you say policy error, you mean the 4 rate hikes that were...
Yes, massive policy error.
I guess fleshed out for investors.
Yeah.
The US economy could simply not have weathered that type of tightening cycle?
Yes, that tightening cycle would have actually made us more bullish US Treasuries. We would have been targeting kind of sub 150 kind of levels, 1.5% levels for the 10-year US rate. Now, with this policy in place, we're thinking now 185 is a kind of fair level, and then even if they then next year take Fed funds up to about 1%, that would mean that we get about 2% for the 10-year US.
Limited moves now that are anticipated
Really?
from the Fed.
Yes.
There's still something in it for the yield chasers. Do you think investors are going to be still reallocating money towards US Treasuries at this point?
I do expect so, and I think the Fed, having removed some of that uncertainty, will actually make foreign flows more confident, I would say. And so perhaps they can now be slightly shorter in duration because they don't need to chase the long end of the curve so much. And I'm expecting that we're going to see a slight steepening of the US curve also.
The data's really confusing though out of the States, isn't it? I mean, I looked at the house price information overnight, and the January figure was 5.7%. Based on the Case-Shiller 20-city composite home price index, 5.6% for December. And some centres were remarkable. Portland, 11.8% jump in home prices. Janet Yellen clearly is worried about some parts of the US economy, but the indication would be the housing market is in relatively robust health.
Yeah, I'm going to really date myself because I think it's interesting that the bond market vigilante is clearly dead. There is no concern seemingly in fixed income markets about inflation, notwithstanding that several sort of prominent investors have recently raised that particular point. We're seeing now a fairly broad-based increase in core prices in the U.S. You mentioned home prices as it's reflected in owner's equivalent rent. There seems to be now a clear bottoming in the disinflation in healthcare, with the latest numbers actually showing a pretty sizable bounce back in healthcare inflation. We're seeing it in other subcomponents of the index as well. And of course, with energy prices now stabilizing, it appears at higher levels. We'll get even some throughput in terms of that side of the equation, I suspect, as well. And yet, when we see a dovish Fed, we just see the long end rally. In days past, that wouldn't have necessarily been the case in an environment of rising inflation. There would have at least been some people raising concerns that maybe the Fed is actually overstaying its welcome.